Welcome to the Friends with Money podcast, brought to you by Money Magazine, creating financial freedom for Australians since 1999.
Hello, and thanks for joining us for another episode of Friends with Money, Money Magazine's podcast to help you earn, save, and achieve your financial goals. My name is Tom Watson, a senior journalist here at Money Magazine, and as always, it is a pleasure to be with you. As most listeners will be well aware of at this point, exchange-traded funds have become an increasingly common sight in investor portfolios in recent years. In fact, the ASX's 2023 Australian Investor Study found that 1 in 5 Aussie investors now hold ETFs. So in today's episode, we're going to check in on the state of the ETF market, including a look at some of the most popular ETFs and top performing ETFs over the past year. And joining us to talk about all of those points and more is a man who knows more than a thing or two about ETFs. It's Betashares senior investment strategist, Cameron Gleeson. Cameron, welcome to Friends with Money.
Hi, Tom. Thanks for having me.
You are very welcome, mate. It's great to have you on the pod. Now, a lot of the data in our conversation today has come from Betashares' recent end of 2023 Australian ETF review. So for anyone who is interested in having a bit of a look at the figures in more detail, I would definitely recommend giving that a read. And we'll also pop the link to that review in our show notes so you can go and easily find that. All right, Cameron, let's kick things off. I was hoping you could, set the scene for us a little bit by giving us an overview of the ETF market in Australia at the moment. So how much money do Australian investors have in ETFs right now? And how has that changed over, the last 5, 10, 15 years, whatever time frame you'd like to talk about?
Yeah. So the total assets under management as at the end of December 2023, it was $177 billion assets under management.
Wow.
And now, just to talk about, how big that figure is or where that's come from, the first ETF listed in Australia in 2001, so just over 20 years ago now. But it really has been the last sort of 5 to 10 years where we've seen that adoption rate of exchange-traded funds and the advantages of Australian exchange-traded funds become clear to Australian investors. Over the last year, we saw net inflows, that's net buying activity by investors into ETFs, of around about $15 billion. That was over 2023. And that's been consistent over the last sort of 5 or 6, 7 years, strong inflows into exchange-traded funds. Now, the other main investment vehicle that people might choose to invest in would be unlisted managed funds. So an actively or passively managed unlisted fund that you apply for using an application. The majority of assets in Australia still sit within unlisted managed funds, still around about sort of 60% of assets under management. ETFs are the smaller portion of the overall market, but the flows are moving from unlisted funds, which have been in net outflow, into ETFs. So there's a clear preference there. Now, what's sort of been interesting is sort of that uptake. Before COVID, we were sitting at around about $100 billion in assets under management within the ETF landscape. Middle of last year, $150 billion assets under management, and then by the end of the year, up to $177 billion. So that growth continues to be strong. That adoption rate is certainly very encouraging for the industry.
Cameron, what do you think are the kind of main motivators there that are, increasingly drawing people towards ETFs and perhaps at the expense, as you said, of kind of traditional managed funds?
Yeah, I think originally one of the key points or key reasons why people looked to use ETFs was if I wanted to build a portfolio for myself as an Australian investor, perhaps 10 years ago, I might decide to select my own Australian shares. So I'd likely be familiar with the big miners, the big banks, maybe Woolworths, Wesfarmers. But I didn't have international exposure, which was easy to access via my online trading account. And so using an ETF gave me great access to international markets, diversified exposure to the US or global markets. And that was really the first use case, was in fact accessing global markets. And then over time, people started to see that they weren't necessarily that great at picking individual stocks. And so investing in a low-cost, diversified Australian equities exposure became quite popular. And then since then, in the last 5 years or so, what we've seen is really the emergence of fixed income as an asset class, which I'm sure we'll talk about. But people looking to invest in fixed income and cash through ETFs has a lot of advantages. So some of those advantages are obviously cost. Typically, passively managed ETFs are far lower cost than actively managed unlisted funds. the transparency of the price that you trade at, the ability to know that price and trade on market, and the ability to really manage your entire wealth within within an online trading account, for example. These are some of the advantages and the reasons why we've seen people shift towards ETFs.
Cameron, you mentioned fixed income and cash there, and I'd like to kind of dig into that a little bit. So throughout 2023, which categories proved to be, I guess, the most popular with investors, and what do you think was kind of driving that?
Yeah, 2023 was interesting. If we look at the year as a whole, the most popular category was fixed income. And that doesn't even include cash. So fixed income plus cash pulled in around about sort of 45% of all net inflows for the year. Now, part of investor behavior is determined by if you like, risk appetite. And if we think back to the first half of the year in particular, investors were relatively bearish on markets. So they were looking to allocate to the defensive assets in their portfolio. And we know that cash and fixed income tend to be lower risk, lower volatility than equities, typically in the overall market cycle. What we did also see in the first half of the year was, in fact, net outflows from international equities. And again, this is a sort of typical type of market behavior for investors where they're feeling a bit risk averse, a bit bearish. They tend to pull back from global markets and allocate more to Australian markets and indeed defensive asset classes. Then what we sort of saw in the second half of the year was a pick-up inflows in international equities. And that's what's really sort of led to the strong flows into the start of 2024 has been a greater willingness to take risk and to invest in equities, in particular international equities. So that sort of change in behaviour did shape the year. But overall, defensive assets, including cash, fixed income, which you can get at a really low cost point in terms of management fees within ETFs, was the leading asset class.
I'll keep driving down then, Cameron, into some specific ETFs then. So what did you guys find to be the most popular products in the market with Aussie investors when it came to market cap? And again, were there any kind of changes in 2023 on this front?
Yeah. So I'll talk a little bit about perhaps the net inflows, because that gives you an indication as to where the market is moving, and then talk about the largest ETFs available. Where we saw large flows last year, and indeed in most years, is we tend to get very large inflows into the very low-cost, diversified Australian equity ETFs with good reason. So, for example, Betashares A200 ETF is the lowest cost broad market Australian equity exposure, and the management fees on that are 0.04% per annum, so incredibly low cost. So the three largest funds for inflows were all broad diversified Australian equities exposures. So Vanguard Australian Shares Index Fund, Betashares Australia 200 Fund, A200, which I just mentioned, and iShares Core ASX 200 ETF. They're the funds that tend to get the largest flows. And then beyond that, we did in fact see some interesting flows into fixed income and cash. So AAA, which is our Betashares high interest cash ETF, saw just under or about $750 million worth of flows for the year, people looking to allocate to cash. And then we saw flows into US Treasury bond ETFs. And that was a really interesting development. We haven't seen people look to access US Treasuries as an investment in Australia much before the last year. But with a lot of the news cycle around what the Fed was doing and some very interesting movements in US government bond yields, people were looking to access US Treasuries through ETFs to play what they saw as a resolution of inflation and really profit from movements in bond yields. So they were some of the interesting movements we saw. And of course, following on from my initial point there about the strongest flows typically being in those core diversified Australian equity funds, they tend to dominate the top 10. A200, our Betashares Australia 200, entered the top 10. We also saw that our NASDAQ 100 ETF entered the top 10 within the last year. A lot of that, in fact, was due to the significant gains or the strong performance of the NASDAQ 100, which meant that the assets within that fund increased substantially. I think total gains on the NDQ or NASDAQ 100 fund were roughly, I think we're looking around about 50 or 60% for that fund. So that was a huge year for performance, which meant that fund became much larger than it had been at the start of the year.
Now, I mentioned in my intro that we'd be discussing some of the top performing ETFs in 2023, and I'm not going to disappoint you listeners. Cameron, what made the top 5 lists in terms of performers for 2023?
Yeah, it's a really interesting question. I wanted to maybe talk to you about some of those top performers, but then really think about what more diversified or core funds also did really well this year, because I think that can be sometimes more applicable for clients or investors. When we look at the top performers, they were really dominated by ETFs that provided exposure directly or indirectly to digital assets like Bitcoin and Ethereum. And we also saw very strong performance from technology-related exposures. So exposures that had some sort of, ETFs that had some sort of exposure to the NASDAQ alike, perhaps on a leveraged basis. The top performing ETF last year was in fact CRYP, CRYP, which is our Betashares Crypto Innovators ETF. It returned 214% for the year 2023. I should say that came off the back of substantially negative performance in the two prior years. So that strong performance, obviously a really good outcome for that year, but this is, and all ETFs that provide exposure to digital assets, this is a very volatile exposure. So we must take that into account when we're looking at these sort of return figures. Again, one of the other strong performers was a leverage exposure to the NASDAQ 100, so LNAS, so that provided a return of about 130% per annum. So these are really strong returns, but obviously crypto assets or using leverage does introduce volatility. So there, on that point, I thought it was interesting to look at maybe some more core diversified funds that might make more sense within your portfolio. So we look within Australian equities. What are some sort of core Australian equity funds that did really well last year? And the one that stood out there, the best performer in terms of diversified funds, was AQLT, which is our Betashares Australia Quality ETF. This returned 20% for the 2023 year, just under 20%, versus the broad market, which returned about 13%. So strong outperformance there. Within global equities, I mentioned NASDAQ 100 was a really strong performer, up around about we're looking around about 53% there. But IVV, the US S&P 500 exposure from iShares, up 25%. So US equities did really well. So we know that story. Maybe a regional exposure that people aren't so familiar with is Japan. Japan's equity markets performed really strongly last year. And as a result, our Betashares Japan ETF, which is currency hedged, it's HJPN, returned 35% for the year. So that was a bit of a dark horse in terms of its performance there. And then we look in fixed income, and we saw obviously those strong inflows in fixed income. The best performing fixed income fund was, in fact, CRED, C-R-E-D is the ticker code, Betashares Australia Investment Grade Corporate Bond ETF. And that returned just under 11%, which is obviously quite a strong return for an asset class like fixed income, which tends to be a little bit lower volatility. So hopefully there's some funds that did really well. And if you want to have a look, potential tools you can use in the core of your portfolio that have perhaps a bit of a lower level of volatility than digital assets and leverage technology.
Obviously, cryptocurrency was a theme that, did heavily feature there. So on that note, Cameron, I'm sure listeners will have heard about the recent news out of the US in regards to the SEC giving the green light to spot currency crypto ETF. So does Betashares have any plans to offer something in that kind of vein in the future at all?
Yeah, stay tuned. In the Australian market, there are some differences within the US in terms of the plumbing and the way that ETFs work that are required to be overcome to ensure that we can offer people really effective exposure to direct spot Bitcoin or spot Ethereum, for example. But I think in that those issues will be solved. I mean, overall, when we do talk about exposure to crypto assets, I think that the ETF wrapper has some, really strong advantages versus perhaps holding your cryptocurrency on an exchange if that exchange, in fact, introduces counterparty risk to you. So there can be some strong advantages. But when we talk about building a portfolio, we do like to acknowledge, to investors that, exposure to crypto does come with a high level of risk. And so some years will have very strong performance like last year, and something like the announcement of 11 spot Bitcoin ETFs in the States may lead to a significant jump in the price of these assets, but there is significant risk. So you want to think about the sizing of your investment in that particular asset class when you're building a well-diversified portfolio.
I think that's an excellent point, and we've already seen the results after that initial spike on the back of the SEC news. Cameron, it's been great to look back on 2023, but I'd be curious to get your thoughts on the months ahead now as well. So, what are you thinking right now? Are there any trends, any themes, any expectations that you have for the ETF market in 2024?
Yeah, I think there's maybe two kind of key things. The first thing would be on an asset class basis. I mean, I talked about where the flows were in 2023. I believe that with greater certainty on the path down or out of a high inflationary regime, we're going to see a greater risk appetite. And that's going to be probably more flows into international equities and less so into defensive assets. That's my view on an asset class basis. But I also think that people are learning to use ETFs in different ways. So that sort of original use case of getting the lowest cost diversified equity beta or broad market exposure to the equities at lowest cost is a really strong use case for ETFs. But indeed that we're seeing people look to use, I'll call them enhanced passive approaches to investing that can add value to your portfolio. So an example might be a low-cost passive approach that filters to invest in quality companies, which we all know that quality companies tend to be quite resilient in a drawdown. So the use of these sorts of ETFs, which aren't necessarily the entire market, but are skewing to a particular subset of companies, can be really useful in portfolio construction. And we're seeing investors increasingly adopt these types of investments within their overall portfolio to diversify their exposure. And obviously, there's some advantages to bringing in different characteristics for your overall risk.
That is a really interesting point to leave things on today, I think, then, Cameron. We'll have to get you back on to give us a bit of an update later on in the year, though, if you're interested. But thank you so much for coming on today. It's been a real pleasure chatting.
Thanks, Tom. It's been a pleasure.
That's it for this episode of the Friends with Money podcast. But don't forget to jump on our website, moneymag.com.au, for your daily dose of financial news. Or you can go grab yourself a copy of the latest edition of Money Magazine in all good newsagents. As always, we'll be right back in your podcast feed next week. So until then, I'm Tom Watson. Bye for now.
Thanks for listening to the Friends with Money podcast. For credible, independent, and easy to understand financial commentary, visit moneymag.com.au. Please remember that the views and opinions expressed in this podcast are general in nature, and further independent advice and research based on your personal circumstances should be sought before making an investment decision.